What's up everyone, it's Scotty with Money Investing. So in today's video, we are going to be talking about Netflix, ticker symbol NFLX. It is down a little bit over 6%, so I wanted to go over the entire earnings for this company, break down exactly what they reported, and of course go over the intrinsic value calculation, the fair value of the stock, and go over the technical analysis on this company as well. So a revised, updated fair value on Netflix with an entire analysis on the company's earnings as well. As always, if you enjoyed this video, find it helpful, make sure that you drop a like. Don't forget to subscribe to the channel. If you're just joining us for the first time, there is a 16% annual discount available on Discord that gives you access to all the buy and sell alerts, options alerts, trade ideas. In fact, today is the day I'm starting a brand new position on a brand new stock, and I actually did a video on this for all the members, so you can check this out. This was posted just a few hours ago, talking about buying and starting a new position in this stock, and you can expect a lot of private videos from me over the coming months and years, going over individual stock analysis, where I would be buying certain stocks, my core holdings, so portfolio updates, stocks that I'm buying. Everything is going to be covered as part of your membership and our Patreon and our Discord. So links going to be down below, and we'd love to have you on board. We've got a community of almost 4,000 members just talking about investing, trading, finance, technical analysis, fundamentals, options, everything. So that's going to be your go-to place with the global community, of course, people from all over the world. So we'll welcome you any day. So Netflix subscriptions jump 8%. Revenue climbs as password sharing crackdown takes hold. So Netflix said Wednesday that its quarterly revenue and subscriptions rose as efforts to curb password sharing took hold. So there's two really important tailwinds for the company right now. Number one, password sharings, which means that people that are using passwords of their family members are going to get segregated. So now they're going to have to use either their own account, or the person whose passwords they're using will have to add them as an additional person on their account, which I believe the fee is about $7.99. So that's number one. Number two, ad-supported tiers. So people who don't necessarily want to pay the higher $14.99 or $19.99 per month fees for Netflix can opt into a lower tier, which I believe is $6 or $7 or something like that, and they can get commercials, they can get ads while they're watching Netflix, which I know can sometimes be annoying, but that's what YouTube and YouTube Premium is all about. The only difference is YouTube in general is free, and YouTube Premium is a paid tier where you don't get ads. So those are the two main tailwinds for Netflix, and that's how they're expecting to make more revenue and kind of reignite their growth moving forward. So EPS came in at $3.29 versus $2.86 expected. Revenue came in at just a little bit over $8.1 billion versus $8.3 billion expected. So beat on EPS, a slight miss on revenue here from the company. And they also said Wednesday that it expects to boost in revenue in the second half of the year as it begins to, quote, see the full benefits of paid sharing plus a steady growth in our ad-supported plan. So just the two tailwinds I talked about earlier, and Netflix said it now forecasts revenues of $8.5 billion, up 7% year over year. And the company also anticipates paid net subscriber additions in the third quarter will be similar to the second quarter. By the way, second quarter, they added close to 5 million subscribers. And meanwhile, Netflix expects revenue growth in the fourth quarter to, quote, accelerate more substantially as the efforts to curb password sharing gain steam, and as advertising revenue also grows for the company. So revenue was up a little bit over 2.7% on a year-over-year basis to just under $8.2 billion here. Operating income was $1.8 billion. That was a 22.3% operating margin, which was substantially better compared to the last four quarters. It was the best in the last four quarters. And net income also came in at just under $1.5 billion, which again was the highest in the last four quarters, with EPS coming in at $3.29. So very strong numbers being posted by Netflix. Of course, a slight miss on revenue. That's understandable, but of course, substantial acceleration expected in the second half of 2023. And global streaming paid members jumped to 238 million. Again, that's all on their efforts of password sharing, kind of people having their own accounts, and also ad-supported tiers kind of igniting their growth here. And that's an 8% growth year over year, and they added over 5.8, almost 5.9 million subscribers, and this is the highest going back as far as the fourth quarter of 22. And net cash provided by operating activities, $1.4 billion. Free cash flow, $1.3 billion, and shares outstanding, 451.6. So very, very small amounts of share buyback. Now, they've also gained as a market share as a percentage of the streaming business. So you can see the share of US TV screen time, and the black is going to be broadcasting, gray is going to be cable, and light blue is going to be streaming. That's where Netflix lives. And you'll notice that back in May of 21, Netflix was the leader with 6% market share of that 26% streaming market. And now you'll notice that they're just behind YouTube. YouTube's just been able to grow much faster than Netflix, but nonetheless, they've got over 8.2%. That's a pretty substantial growth on in the last couple of years here, as all the services have grown. Disney's gone from 1% to 2%. Prime Video has gone from 2% to 3.2%. Hulu's gone from 3 to 3.5%, but Netflix and YouTube has seen the most growth from 6 to over 8.2 and 8.8% respectively. Disney, of course, on a percentage basis has doubled, so it's gone from 1 to 2%. So you can technically say that they grew 100%, but really it's the YouTube and Netflix that they're going head to head on when it comes to streaming. This right here was the revenue and the actual additions, all subscribers and average revenue per membership by region. So regional breakdowns, you'll notice a revenue, $3.6 billion from the United States, Canada, North American market, and net additions were just a little bit over 1 million, with $16 being the average revenue per membership. So that's actually quite interesting that even though they actually grew in the members in North America, they did not come down in the average revenue per membership because their ad-supported tier and their password sharing is definitely lower priced tiers for Netflix. So again, the ad-supported is running at roughly around $5 to $6 or $7 per month. I could be wrong, don't quote me, but it's really low. Like it's 50% discount to what the regular tier is, and they're still able to maintain that average revenue per membership, which just goes to show that the strength of Netflix users is very strong, and Netflix is doing a really good job in kind of keeping them retention's high. Not only are they adding members, but they're also keeping up with the average revenue per member. Europe, Middle East, and Africa, you'll notice $10.87. So again, slight decline here in a year-over-year basis, and they added over 2.4 million subscribers in the last quarter. And Latin America, you'll notice in beta net addition, 1.2 million, 858 was the average revenue, and APAC, which is Asia Pacific, over 1 million added. So every single region added members for Netflix, and 766, so perhaps the biggest decline, 13% year over year in average revenue per member came from Asia Pacific. But nonetheless, every single one of them grew in terms of users. This right here is going to be the balance sheet. Now, balance sheet's always been a concern for Netflix. Cash and cash equivalents and short-term investments combined are sitting at just under $8.5 billion. And you'll notice a short-term debt, $400 million, and long-term debt over $14 billion. So certainly they've got almost twice as much debt than they have in cash. So company does not have a negative net debt. In fact, quite the contrary, they've got more debt than cash on the balance sheet. Now, going over to some of the estimates. Now, this right here is their earnings expectations. They're expected to grow from $11.72 to over $30 by 2028, and by 2032, expected to get up to over $60 per share, almost $61 per share. That's going to be a compounded annual growth rate of 20 to 21%, with a share dilution of just a little bit under 1% from the company. So we're going to plug in 20% growth for Netflix here. I'm going to go with 10% margin of safety, 0.5% share dilution, 12% discount rate. Right now, the valuation is certainly high. By the way, they're down a little bit over 6%, pre-market trading just under $450. And if you come over to the actual valuation here, 51 times earnings, a little under 7 times sales, and over 65 times cash flow. So definitely very, very high. But I consider Netflix to be a growth stock because, again, expected earnings are over 20%. Anything over 20% is considered to be a growth stock. For me personally, anything over 14, 16% on an annualized basis, year over year, compounded, over the long term, when it comes to earnings growth, is a growth stock. So for Netflix, I think we can go as far as 20, 25 times P multiple. So if you do a 25 times P multiple, we get down to a fair value, which is closer to $370. And right now it's trading at $447. So we're actually not that far off. 17 to 18% decline potentially needed for Netflix to come down to before it starts to become very attractive. And of course, given the plus minus 5% flexibility range, we're looking at anywhere between 350 and 389. And this does kind of ring the bell because 350s were a level that we were watching on Netflix for a long time. And that puts us right over here. And that's going to be a very strong support level to watch for Netflix. One of the things that's always kind of, I've been hesitant in kind of owning Netflix has been the debt level. So like I said, $14 billion is not a small amount compared to the cash the company has. So that's something to keep in mind. But certainly we are a little bit more on the overbought side. There's been a negative divergence, and resistance is going to stay put roughly at $458 to $460. I actually wouldn't be surprised if it does get bought up today because the earnings overall were very strong with some good guidance and some good additions overall on a quarter-over-quarter basis for a lot of these regions. But again, valuation is always going to be concerned. It's priced really expensively. So for support level 397, close to 400, down to as low as 350s. Those are going to be some levels to watch really closely for Netflix. And of course, decide for yourself whether it makes sense, looking at the sensitivity grid, what type of growth rate and P multiples you can apply for Netflix. So I hope you guys enjoyed this video and found it helpful. If you did, make sure that you drop a like. Don't forget, if you want to get access to all the private videos and tutorials and lectures and a lot of educational material, and of course figure out which stocks I'm buying, portfolio update, all those things, link's going to be down below for our Discord. And as always, happy investing, and I'll see you all in the next video.